Hello and welcome. We will continue our NAPS. NAP stands for Nonprofit Auditor Points, and I'm Irina Orishkova, your nonprofit auditor. Full disclosure, these videos are not authoritative. I designed them just to help nonprofit community to discuss various challenging accounting topics. We have a small CPA practice in downtown Oakland where we serve nonprofit organizations by providing auditing and tax services. And thank you for being here today with me. And today we will continue talking about new lease standard 842. In the previous video, I discussed the purpose of 842, the finance lease versus operating lease, 5 criteria, how you determine what is the capital lease and versus operating lease, and that under new standard, finance lease used to be capital lease. Treatment did not change at all. It's still going to be capital asset. You're depreciating it as before. Nothing is new here. All changes in the new standard are applicable to operating lease. And I briefly will discuss today what the organization need to do in order to treat operating lease correctly. I will not be able to show you calculations, and if you have any specific questions, please do contact me or your auditor or your finance team for any detailed calculation. I will touch base of overall understanding of operating leases and how they should be present on financial statements. Okay, let's start. Operating lease. What is the operating lease? Operating lease, it's a lease under which nonprofit organization has a right to use their asset for specific period of time, but does not have ownership of the lease at the end of the term, and it will not does not satisfy any of the 5 criteria for finance lease. So what the organization need to do? First of all, the organization need to know all its leases. Each lease agreement needs to be pulled and analyzed if it's operating lease or finance lease. If it's finance lease, you do capitalize. If you're operating lease, then you do what we're going to discuss right now. But there definitely has to be better procedures regarding reading the leases and understanding of the lease. One comment. I noticed that some of the landlords, in order to help nonprofits or other companies, trying to hide or fully omit the word of lease from the agreement in hopes that it will not be a lease. Regardless how you call it, if it's a lease, it's a lease. So please do not be deceived if it does not say word of the lease. Under lease, the organization receives substantial use and rights to use of the asset for the period of time. Therefore, if the agreement substantively has this right, it's a lease. Then the organization needs to see if under this lease agreement, if it's more than 12 months, it's a long-term lease. If it's a short-term lease, you don't have to worry about it. You don't have to apply 842. But if it's more than 12 months, starting 2022 and prospectively, you need to apply new lease standard. If the organization had a lease that was signed prior 2022, you do not need to go back and recalculate anything in order to implement this new lease. You're starting it from 2022 and prospectively. So what this new lease standard does, prior 842, the organization could have signed long-term lease under which the organization would be liable to pay for this lease for 5, 6, 7 years, but there would be absolutely no liability on the balance sheet. New lease standard allows more transparency and demands nonprofits now to put that liability right on the face of the balance sheet, but it also allows nonprofit to put intangible asset called right of use for that related asset. So now the readers of financial statement can see right there on the balance sheet right of use, intangible asset, and liability. One point, right of use, it will be intangible. There is no cash value to that. It's intangible asset. Liability, it's actual future payments of this lease. Also, because it is a right of use, it's intangible asset, on your balance sheet, it will be non-current asset. One line, right of use. So if the organization has a lease for 5 years, it's calculated right of use, it's going to be one line item under non-current asset. Associated liability, because it's actual cash outflow, it means that organization will need to pay for that lease for the next 12 months and afterwards. So therefore, liability will be split into parts: current liability and non-current. Current liability will be payments for the next 12 months, and non-current liability will be payments for the after next 12 months. Therefore, on your financials, if you're presenting balance sheet split in a current, non-current, you're going to see only one line for right of use of the asset and current liability related to the lease and non-current liability. Hopefully that explains. Under new standard, nonprofits can implement package of practical expedients, and all our nonprofits do. Under this package, nonprofits allowed not to separate non-lease components with the lease components. Let me explain you what that means. It means that very often nonprofits can sign a lease agreement for their office under which organization has to pay $5,000, for example, a month. Most likely this $5,000 includes actual use of facility of the premises, plus some common area maintenance expenses, utilities, and so forth. Common area maintenance, utilities, they are not leases. However, because they're challenging to separate from the overall lease payment, these practical expedients do allow not to separate that amount from overall lease and just treat as all $5,000 as a lease expense. It makes life easier. So therefore, organization can take this all $5,000 and calculate future payments and right of use. So how do organizations supposed to treat their lease agreements? As I mentioned before, all lease agreements needs to be you need to do inventory of all your lease agreements. Then nonprofits needs to assess which lease agreement is capital or finance lease, and the new terms, finance lease, and those are capitalized and depreciated, same as before. The rest will be operating lease. Then under operating leases, the organization need to take a look which of them are only 12 months or month-to-month leases. The new standard is not applicable to those. And then take a look only on your long-term leases that more than 12 months. And then organization needs to see if there's extension on the leases. Meaning sometimes lease can be for 5 years and there's additional 5 years to extend. And if it's reasonably expected that the organization will use this extension needs to be added to the life of lease. Those leases needs to be used to calculate right of use and future lease payments. Each lease agreement needs to be looked at and see what the actual payments are based on the lease agreement. Payments are just cash flow, how money gonna be paid, exchanged, right? Because the organization receives the right of use asset and in exchange for consideration for the payment. So Monthly payments, it's really just exchange for consideration exchange, but it's not a lease expense. Most office leases do have step up annually. Therefore, the organization needs to calculate for each period, let's just say monthly, actual cash payments, then calculate present value of that payment, and then total amount of liability based on the present value needs to be straight lined, meaning the total number needs to be equally divided for each period when the organization gonna lease asset. Why? Because that's gonna be your lease expense or rent expense. Under GAAP, organization has to recognize an expense that equals for the exchange rate, because the asset the organization gonna use exactly the same, not gonna change from month to month. Expense should be identical for the whole period of use the asset. Even though your payment will fluctuate, cash payments, expense right of use should be the same. When the organization gonna calculate present value of the lease payments, the organization needs to use their interest rate. And interest rate, we do for all our small nonprofit organization, we use free rate discount rate. And that rate is a treasury bill rate, which can be found on the Yahoo Finance. And that's allowable for nonprofit organization, which is can go to Yahoo Finance and find treasury bill rate that the same life of the lease. For example, if a lease is 5 years, we will find treasury bill for 5 years. If the lease is 3-year lease, we will find T-bill interest rate for 3 years, and so forth. It needs to be comparable with the useful life of the lease. The interest rate do not need to be recalculated every year. So when the organization is calculating from inception of the standard, this new lease, it needs to find out the rate and apply it. The organization can also use actual implicit rate, interest rate, but that rate needs to be known. For a lot of our small nonprofit who do not borrow money every year, we don't know that rate, and nonprofit does not know that rate. So we cannot use the actual borrowing rate of the organization. Therefore, we use free discount rate, which is treasury bill rate. Again, very easy to determine treasury bill rate. And that's going to be the calculation of the present value in discount. Therefore, once you do calculate the expense on a straight line, you also have your liability, and there's additional calculation when you do determine your asset right of use and you determine your liability and you do record it on financials. And every year you can either at the end of the year you do adjustment entries to reduce your right of use and reduce your liability, and adjustment will be adjusting to your rent expense, or you can develop monthly recurring entries and record your payments correctly in accordance with schedule. Unfortunately, because of the limitation of the presentation, I cannot show you the entries, but this is the premise how to record lease liability and right of use asset. I would advise that organization do update your year-end procedures to include reconciling your right of use and lease liability to the schedule at least annually. So your rent expenses properly reflected, your any new leases are properly added to the schedule, and so forth. So that's very brief summary of operating leases. what under new standard, what nonprofits do allow to do, and how they need to be presented under financial statements. If you have any questions, you're more than welcome to contact me. I will see what I can do, or you can contact your own auditor and accounting firm. Thank you so much. Hopefully that was helpful, and I'm looking forward to see you for the next snap. Thank you, and have a wonderful day.